Any successful day trader knows how to do these four things when it comes to chart analysis. Number one, being able to simplify your trading by using indicators. Number two, being able to spot patterns. Number three, candlestick analysis. And number four is a bonus. So let's talk about the first three and then we'll jump into the bonus. Let's get started. Indicators allow you to spot trends, swings, and patterns. Every day trader has their favorite indicators they apply to their charts. Some day traders like to load up their charts with a multitude of indicators. I like to keep my chart simple and clean by only applying a few indicators. We applied the simple moving average indicator, but there are actually four indicators that I usually use when I day trade. These are the 20 EMA, 100 EMA, slow stochastics, and MACD. Now, MA stands for moving average and EMA stands for exponential moving average. A moving average takes the average of the trailing closing prices depending on how many prices you want to look at. A 20 EMA, of course, then would look at the average of the last 20 closing prices. Moving averages give us a great view of where a stock is trending. I use the EMA instead of the moving average, the MA. The EMA, or exponential moving average, puts more weight towards the recent close prices. As a day trader, I like to put more weight toward the recent price data, as this is what I base my buying decisions or selling decisions on. I use the 100 EMA overlay to show the longer 100-day average trend and the 20 EMA to show the current, more volatile trend. Just by having these two indicators alone, I can quickly tell if the stock I'm analyzing is trending up, down, or sideways by comparing the 100 EMA to the 20 EMA. This is the longer time frame analysis. If the 20 EMA line is below the 100 EMA line, the chart tells me that the stock is trending lower. If, however, the 20 EMA line is above the 100 EMA, the stock is in an upward trend. I continue by focusing on the 20 EMA and see where it's trending compared to the candlesticks. This is the short time frame analysis. If the 20 EMA is below the candlesticks, we are looking at an upward trend. And if the 20 EMA is above the candlesticks, the stock is trending downward. If the 20 EMA is in line with the candlesticks, then the stock is trending sideways. These first two indicators tell me if I should go long, short, or hold off on investing. I never invest on a hunch, and I don't have a gambling mindset when it comes to investing. I never trade on sideways chart patterns that don't show any type of trend direction, either up or down. The best setup I traded as a beginner was an upward trend, which continuously achieved higher highs and higher lows. With this setup, the 20 EMA will be above the 100 EMA. The 20 EMA will be below the candlesticks. This setup allows me to go long. Now let's look at the slow stochastics. This indicator displays when a stock has been overbought or oversold. As a day trader, we can position ourselves to take advantage of these two conditions. Many times, emotional investors panic and start selling at a rapid pace. This can cause the stock to go into an oversold condition. If you look at the slow stochastics, it will be trading under 20. Other situations might cause investors to become overly optimistic and greedy, pushing the price of the stock up into an overbought condition, above the 80 line on the slow stochastic chart. So how can we make this work to our advantage? As a trader, I only buy when stocks bounce back from being oversold, and I only sell or take profits when the stock is in an overbought condition, about to reverse. You can never predict how far a stock will rise or drop. That's why I buy or sell right when I see the trend reverse, when a stock is overbought or oversold. The last indicator I use is the MACD, which stands for Moving Averages, Convergence, Divergence. Stocks have a peculiar rhythm where they sway up and down like waves in an ocean. The MACD allows me to uncover this rhythm, allowing me to locate my entrance and exit strategy for a stock. The red and green bars in the MACD show me the momentum of the stock. There are also two lines on the MACD, which are two different colors. If the lines cross each other, it shows me that the momentum has changed. I like to hover my cursor over the slow stochastics, then compare it to the momentum in the MACD, and then look at the candlesticks on the chart. Indicators, however, will never be a sure thing. Indicators are just guidelines you use to do technical analysis. Some notable indicators that investors also use are Bollinger Bands and Fibonacci retracement levels. After setting up my indicators, I continue by drawing support and resistance lines on my charts. On a chart, you will notice specific price points which show a lot of trading activity and no breakthrough these price points. Stocks eventually do potentially break through their support or resistance levels after they have been tested for a couple of times. There are many reasons why support and resistance levels form. Sometimes investors have specific price points where they want to sell or buy. The previous day's close price can also act as a resistance or support level. When investors miss a specific trade price point to enter or exit an order, they will remember that specific price point, so they wait for the stock to hit that price again before they take action. As day traders, we locate these support and resistance levels, which gives us a clear indication of entry and exit points. After analyzing indicators and locating support and resistance levels, it's time to look at the candlesticks. It's best to analyze a series of candlesticks, of course, to determine a pattern, but you can also derive a lot of information from the candlesticks themselves. A couple of candlestick types I pay attention to that give me critical information are the long candlestick, the short candlestick, the doji, hammer, and shooting star. So the long candlestick shows intense buying and selling activity. The short candlestick shows slow to no price movement. The doji is a candlestick which looks like a plus sign. It tells me that the stock could trend in any direction. There is no trend to be noticed because the stock opened and closed at the same or slightly different price. The hammer is a small body with a very long lower wick. This tells me that there has been a significant drop in price followed by a lot of buying activity that pushed the price back up. This usually happens when the stock hits its support level. The shooting star is a reversed hammer. This shows me that there has been a big push to sell to get the price closer to the opening price after reaching its high. This candlestick is usually seen close to a resistance level. Taking these candlesticks in conjunction with previous sticks on the chart will allow you to spot interesting trends and patterns. And as a bonus, let's talk about the level 2 quote. There is a quote system that allows you to see real-time quotes on bid and ask prices, which is called level 2. Buyers' bid prices and sellers' ask prices give you a deeper level of stock analysis, which can show you where there might be a congregation of buyers or sellers at specific price points, which allows you to plan your buy or sell decisions. A level 2 quote lists the different exchanges and also the size of the buy or sell order. Supply and demand are what a level 2 quote will show you. If there are more buyers than sellers, the price of the stock will more than likely go up. Vice versa, more sellers than buyers means that the price of the stock will go down. Now, if you like these quick tips that I gave you on day trading as a beginner, then make sure to subscribe to my channel and watch my other videos.